one thing I've been forgetting to do is to remind everybody that I'm not a financial advisor. I am just an ex-teacher. So bear in mind that this is an area that you're probably going to want to take proper qualified financial advice for. That is not something I am, but I am an ex-maths teacher, so I'm fairly comfortable with numbers, and hopefully I can give you a bit of guidance on what is meant by the new remediable pension savings statements that are coming out at the moment and are causing a lot of worry and confusion. And I've set up a spreadsheet that I hope can help you work out whether or not you owe anything. There is a link in the document that takes you to the government official one, so probably worth looking at that. So we've got these letters that have arrived and there's some big numbers in there, and people are going, how on earth can I have paid £50,000 into my pension when I'm only earning 45,000? And it's all to do with the quirk of how the valuation of our type of scheme works. So the letter's arrived, and you've got those steps in the letter that is definitely worth following. And there's a link on there that takes you to a web page for HMRC, which will let you know if you put in your figures and facts, it will give you whether or not you are owing the government money for having had too much of an increase in your pension, which isn't actually a bad thing. You know, if you think about it, you know, if your pension's gone up by a large amount, then you're doing very well. Unfortunately, there are limits on how well you can do. However, the government site, the government page, asks you for an awful lot of information about your salaries, whether or not you've donated to charities, whether you're a member of, you're taking a blind person's allowance, and all kinds of other things, which, you know, if you've got those, great. But it can get bogged down. It can take a long time to get through. So what I was hoping to do was come up with a slightly quicker, and it is only slightly quicker, spreadsheet that I think can help you. And also give you some valuations for if you ask the scheme to pay. Now don't get excited. While the scheme may pay the tax charge, you're going to end up paying it anyway. So one way or another you end up paying with. It's a case of, do you pay a big lump sum now, or do you pay it in bits when you retire? So here's the letter. So let's have a look at this statement. First of all, let's look at reading the statement. So let's zoom in on the top line here. What we have here is a pension input period, a financial year, April 2022 to 2023. And this tends to be the big one. This is the one that is catching most people out. And there's a reason for that. The reason is that inflation in that year was 10%. And if you're increasing your pension's value by 10%, you can quite easily go over that £40,000 annual allowance. So we've got that annual allowance of 40,000. If your salary is less, if you were being paid 35,000 in that year, then your annual allowance is only 35,000. I'll come on to that in a bit. What we've got then is the total pension input amount. Now, our scheme is different. If you're paying into a private pension, then it's simply the amount of money you've paid in. And for a teacher on, say, 50,000, they're probably only paying in £5,000. So it sounds like they should only have a pension input of 5,000. But our scheme is valued differently because we're paying in 5,000, but our pension is being increased as though we were paying in a lot more. The schools are paying in nearly 30%. And the valuation involves multiplying the increase in the value of the pension by 16. That means if you increase your pension's value, if you go from, say, a 10,000 pension to a 13,000 pension, then you've actually, 3 times 16 is 48. You've actually increased the value, according to this valuation, by 48,000. So it's quite easy to exceed the annual allowance, particularly if you're somebody who's at the top of a pay scale or you're going up through the pay scales. So not only have you got that 10% increase, you've also got an increase in your salary to kick in as well. So what we're looking at here is there an excess? Have we gone over the allowance? And in this case, we've gone over that allowance by £13,813. That's quite a heavy excess. And what the taxman's going to want, he's not going to allow you to have tax relief on that. Now, if you're a 40% tax rate payer, if you're earning over 50,270 in this year, then they're going to take 40% of that. They want 40% of that. Wow, 40% of 13,000, you're talking £5,000-6,000. This is quite a large amount of money to pay in, considering you only paid 5,000 into the pension scheme anyway. But there are some little bits in here that allow us to smooth out these bumps. And the 10.1% inflation increase in 2022-23 was one of those biggest bumps that we've had in recent history and for many a year. And so we look at how we can smooth that out. And there is an allowance in the scheme that lets you go back and say, I can use any unused allowances from the past 3 years. So let's go back to this and start looking at what do we look at when we're looking at the past 3 years. So we can go down all of these figures, and they've given you them all the way back to probably 2012, 2011, even 2010. And we can start to look and see where is the excess. So I've got an excess here of about 1,902. That's 2022 year. The 2021 year, well, I didn't get to the 40,000 limit, 3,576 below it. So I'm a bit below there. And we can work our way through all of these columns, looking to see how much we are under or over the allowance. Green being where I'm under, no problem. Red where I'm being over could be a problem. And at the very bottom of my list, you'll notice that 2015-16, that tax year, has been split into two parts. It's been split into what's called the pre-alignment year and the post-alignment year. And there's an £80,000 allowance because this is when they started making the changes, and so they gave that extra allowance in there. And the post-alignment year. So I've put those into two. Now what we're allowed to do is to use any unused allowances for the next 3 years. So if we start at the bottom, then I've got this first red one, £751. And so what I can do is I can take £751 from the previous year, from my 2015-2016 year, and I can say, well, I didn't use it in that year, so I'm going to be allowed to use it in the following year. And that means I'm going to have no tax charge for this where I went over by 750. Then we're allowed to do this for 3 years. So I can also use the remaining part of that unused allowance. So if I've used 750, my 23,700 becomes 23,010. The following year, 3,247. I've still got enough unused allowance from what is now 2 years ago to cover that bill as well, to cover that excess allowance. So again, there's not going to be any tax charge from that year. All these green years, I've no problem. They were under, so I don't have to worry about that. Then I come to the 1902 year. Well, going back 3 years, and we go as far back as we can when we start using allowances, I've got unused allowance of over £19,000. So that's clearly going to be enough to cover that 1,900 over expense. And again, therefore no charge. And that leaves me 17,700 that I've not used yet. However, when I then go up to this year, or the 2023 year, not this year, this was last year, I've got 13,800 that I've gone over the allowance. So I can use back to 3 years. So I go back to the well, I can't use any of the 1902 because that was fully used anyway. I can go back to these other two. And so what I can see is I can bring forward all of the 2020 year, and I can bring forward all of the 2021 year. However, that doesn't fully cover the amount I went over in 2023. And so I'm going to have a tax charge of what is still the excess. So although my excess looks like it's nearly £14,000, my tax charge is just going to be based on what's left over after I've carried forward as much as I can and much as I'm allowed to carry forward. So I've got this tax charge of £3,500. What happens then is they assess how much income tax relief you need to pay back, because you had income tax relief when you were paying into it. And this is where you can lose out. It depends on what your highest rate of income tax was for that year. So if you were earning over £50,270 in 2023, you were getting 40% tax relief at the top end. And unfortunately, they apply that to the whole of the bill. So 40% of that £3,500 means I'm going to owe the taxman £1,400. And this is where my spreadsheet starts to come in. I've got a spreadsheet that will let us work out all of those bits where we took about, carrying forward. You've got to do it manually, but after you've done that, then there's a scheme pays sheet on it. And scheme pay says, if you can't afford to pay the tax bill, or you don't want to pay the tax bill, you can ask the scheme to pay it for you. Don't get carried away. Although the scheme will pay it for you, they will take off some of your pension. So when you get to 60, instead of getting the full pension, they will start to take off bits of your pension to cover the bill of what they paid for you on your behalf. So that's what my spreadsheet's starting to look at, is how much is it going to cost you if you ask the scheme to pay it? It's going to cost you £1,400 if you pay the government directly, but how much is it going to cost you if you ask the scheme to pay it and then have to pay it back later? So in the calculator, we've got these sections. I got 2 years, and this is a different example. I've got 2 years here where I've got a tax charge of £3,500 and a tax charge of £5,000 in different years. And it's key, we've got to apply this to the actual year where the bill is going to be created from. So start off with by putting in how old you were on the 5th of April 2024. I use this to then work out your ages for the relevant years. We put in the tax charges for each financial year, in the financial year. Notice this green section. The allowance that's the maximum allowance that you can have, 40,000 for most years, 60,000 last year. If you were earning less than that, if your P60 says for that financial year you only earned 25,000, then you're going to have to change that green figure from 40,000 to 25,000. So that is a key thing, that your allowance in that column is not fixed. For most people, it'll be 40,000. If you're working as a teacher and you were earning 45,000, great, you can leave it as 40,000. But if you're earning less than 40, you've got to go in and change those green figures. You've then also got to go and put in the tax rate that you were paying in column D. For most of you, that's probably going to be 40%. You may have been only paying 20%, in which case the bill will come down. But so go in and put that in. If you're an extremely high earner, you may even be asked to put in 45%. Look at your P60s, work out what your income tax was for those years, and it's the highest one you did. The sheet then will calculate what the tax charge is for those years. You then got to put in which scheme you were for that year. And because of the rollback, all the ones up to April 2022 is the final salary scheme. So put in the final, you've got to be in the final scheme because the rollback doesn't affect anybody who's wholly in the career average anyway. So those will be final salary. The last two, the top two of these, will be the career average scheme. And it depends what your normal pension age is, depending on how old you are, which of the career average schemes that is. What we get then is a series of calculations that tell us what the debits were, how much you are owed for different sections of this. And you can see that we've got a total tax charge. In this case, HMRC wants £2,391 from you. Or if you ask the scheme to pay this, then they start off by saying your pension is going to be reduced by. And in this case, it'll go down the lump sum. They'll want £146.99 from the lump sum when you get it. And then your annual pension will be reduced by £140.97. So they're going to start claiming back the money that they paid on your behalf. And they claim it back, but they don't stop claiming it when they get to 2,391. They take it for the rest of your life. If you die before you've covered it all, that's not a problem. That's the flip side of it. The debt dies with you when when you die, the pension dies as well. So all the tax charge just wiped out. If you live longer and you end up paying £5,000 back, then you end up paying £5,000 back. It is one of those ones where they're assuming you'll live to an average life expectancy, and you will then have covered the debt at that point. So the comparison really is, do you pay the tax charge now? In this case, nearly $2,400. Or do you have the scheme pay it, knowing that you're going to have a lower pension in the future? So if we look at the comparison, if I say £2,391 now. If I take off the lump sum debit, that means I'm paying roughly, the cost to me, £2,244, the difference. And then we'll divide that by the difference in the pension. Now, the pension's gone down by £140, but of course you're going to be taxed on that. So I normally say that's 20% off. Pensions tend to be in the 20% tax bracket. Take off 20% of that, and that comes out to about 19.9 years, nearly 20 years. And if you're taking this at 60, you can see that if you live to 80, then you've paid back the amount of money you would have paid at the time anyway. If you die before 80, then you've paid back less. If you live to 100, then you've paid back a lot more than if you paid the tax charge now. It's going to be up to you just to make the decision about whether you want to pay it or if you can afford to pay it. I mean, I have seen tax charges of 20, 30, 40,000 pounds. And for those people, they might say, well, I can't afford to do that. And therefore, they're going to look back at the scheme pace and get the scheme to pay the thing, knowing they're going to have a lower pension in the future. One point that I did forget to talk about was this part that I've put a black line in. The scheme is this black line is after the 2019 year. The government have decided that they're going to write off, if you owe anything from the years from 2015 up to 2019, they're just going to write that off. They're going to ignore it. If they owe you something because you already paid a charge in that year, then you can get a refund for it. But otherwise, they're going to write off the bits before 2019, so we will ignore any debts. There are no debts for anything that accrued before 2019, as long as it's to do with the rollback. Right, hopefully that's it. Good luck. Link to the spreadsheet will be in the comments below.